I'm going to actually start. Frequent batch auctions is now an old idea. I'm getting to be an old guy. I've been working on this stream of research for about 15 years now, and I'll tell you about a whole sequence of papers, and then make some connections to issues in crypto and DeFi towards the end. But I want to start with at an even bigger, at a broader level of the biggest idea in finance academics, which is the efficient markets hypothesis. So my colleague Gene Fama is kind of associated with and kind of coined the idea of the efficient markets hypothesis, and he talks about a market in which prices fully reflect all available information as being efficient. And Gene's a pretty reasonable guy. He gets caricatured in the press a lot, but he's a quite reasonable person and an amazing scholar. And he says it's an extreme hypothesis that prices could always reflect all available information. We wouldn't expect it to literally be true. And then he distinguishes levels of information at which the efficient markets hypothesis breaks down, the weak, semi-strong, and strong form. And in his research in the 60s and 70s, what he concludes is that the efficient markets hypothesis works pretty well in the weak and semi-strong forms. And he finds some evidence against it in its strongest form. And the strongest form says you can't beat the market even if you have private information. So the translation of Fama's early work is to beat the market, you have to know something the rest of the market does not know, but you can't beat the market based on looking at information about past prices or looking at public information, like the kind of information you'd read in financial filings. The modern understanding of the efficient markets hypothesis, there's been half a century of research since, is that it works pretty well at short time horizons, but at longer time horizons, there's some forecastability in asset prices. And when the Nobel Prize was awarded to Fama and Shiller at the same time, it was sort of for these two different and complementary views of efficient markets theory. But again, the consensus is that in the short run, the efficient market hypothesis holds up pretty well, whereas in the long run, there's some forecastability based on, for example, the price-earnings ratio in the market or dividend ratios, that kind of thing. So I have quotes up on this screen from an experts panel we run out of the University of Chicago. It was 100% agreement that very few investors, if any, can consistently make accurate predictions about whether the price of an individual stock will rise or fall on a given day. And then the 2013 Nobel citation talks about how such a situation would reflect a rather basic malfunctioning of the market mechanism. So this learning from graduate school in mind, again, efficient markets theory being kind of the most famous idea in academic finance, I was a first-year assistant professor at the University of Chicago when I started reading about the arms race for trading speed in financial markets. And the first salvo, the salvo that got the most attention, was in 2010. I still remember very distinctly where I was when I read about this, and it really startled me and caught my eye and struck me as really interesting as a researcher. A company had spent $300 million to dig a high-speed fiber optic cable connecting financial markets in New York City to financial markets in Chicago. And it shaved round-trip data transmission time between these two markets by 3 milliseconds. So if you blink your eye, that takes about 300 milliseconds. So 100th of the time it takes to blink your eye. Industry observers said 3 milliseconds is an eternity. And they actually joke that the next innovation is going to be to dig a tunnel, so go through the Earth rather than around the Earth to further shave transmission time. And that actually kind of happened. No one literally dug the tunnel, but microwaves zap information faster from A to B than does high-speed fiber optic cable because of the physics of getting light through air versus glass. So spreads cable actually became obsolete within about a year. And the arms race for speed continues. It's now commonly measured in nanoseconds, in billionths of seconds. I'll show you some data on this as we go. And as you'll see, it's significant dollars. It's on the order of tens of billions of dollars a year across various financial asset classes. It takes the form of hardware, software, communications links between exchanges. And I think most importantly and most difficult to directly measure is all the high-quality human capital that goes to shaving millionths and billionths of seconds off of trading times. So the question that animated my original research on this problem, and that's kind of driven me for the last 15 years on this problem, is how could such small speed advantages be worth so much money? And economists typically think about fundamentals versus technical trading strategies. So fundamentals seems implausible because how could a 3 millisecond head start be about fundamental information? Fundamental information about a company's earnings, for example, gets released once per quarter, which I calculated, what's that, about 8 billion milliseconds. And also information about earnings gets released after the market's closed. So having a 3 millisecond jump on that doesn't really do you anything. The other option is technical, so information about past prices, for example. And economists have always been really skeptical about technical trading strategies. So if you turn on CNBC and you see someone talking about a head and shoulders pattern or a stock breaking through its 200-day moving average or all those other charts, financial economists are really condescending towards that kind of research. So Burton Malkiel, in his famous book, called it usually amusing, often comforting, but of no real value. And again, the Nobel Committee called it a rather basic malfunctioning of the market mechanism if you can predict where prices are going. So where my research converged on, this is work I'll talk about over a stream of papers, first with Peter Crampton and John Shem, is that the underlying source of the arms race for trading speed is a flaw in the structure of modern financial markets. And in particular, the combination of treating time as a continuous variable and processing requests to trade serially. So that is one at a time in order of receipt. So the answer we find is a structural problem in the underlying market design. I'll show you that the combination of continuous time and serial processing means that you can make riskless arbitrage money from symmetric public information. So from information that this whole room understands equally well how to trade on, someone can make money, or actually any of us could make money trading on that, so it becomes a race in speed. That's a violation of efficient markets theory. You should not be able to make money from information about past prices, and it's a violation of efficient markets theory built directly into the underlying market structure, into the continuous limit order book that's used widely throughout modern finance. These riskless arbitrage profits, so first of all, they're just not supposed to exist in a well-functioning market. And I'll show you that they harm liquidity. They're like a tax on liquidity provision in financial markets. And they induce a never-ending arms race for speed. So I showed you the spread networks cable, and I'll show you a lot of the evolution since then as we go. The market design solution that my collaborators and I proposed and analyzed is we call frequent batch auctions. So put time into units, so put time into discrete time units, and then process requests to trade in a batch process using an auction, using a uniform price auction. And there's some design details that are subtle and important, and I'll go through those too. And some of the frequent batch auction attempts or efforts that have been made in traditional financial markets, and there's actually been progress in US equities markets, European equities markets, and a little bit in futures markets, but none of them are quite the collection of design details that we think really solves the problem. And I'll talk about the reason, the economics and of why as we go. I'm going to talk at relatively high frequency. I'm going to try to cover 14 years of research in 35 minutes or so. But let me get right into the first paper in this stream, which came out in the Quarterly Journal of Economics in 2015. I'll then talk about some more recent work that quantifies the problem and some more recent work on the economic incentives to innovate to solve the problem. These papers came out more recently in 22 and 24. And then last, I'm going to draw some very explicit connections to crypto markets and decentralized financial markets and ask for some specific future research. I think one of the great opportunities for research is to have research be a two-way street between traditional finance and crypto finance. So to use the data that's available in crypto markets to analyze the crypto markets, but also bring learnings from the amazing data that's available because of just the nature of blockchain trading back into and inform the rest of finance research. And then if there's time at the end, I'll talk about some even more recent research on what we call flow trading, but I suspect that I'm not going to have time to get into that most recent paper. All right, so let me talk about the frequent batch auctions paper that came out in the Quarterly Journal of Economics in 2015. This is kind of the main paper about the idea of frequent batch auctions. I mean, we started working on it in October 2010. All right, so I'm going to start with some empirical facts about continuous trading. This is data over the course of a trading day on the prices of the two most heavily traded instruments that track the S&P 500 index in the United States. So one of them is the ES, the E-mini futures contract that trades in the Chicago Mercantile Exchange. That's the blue. And the other is the SPY, an exchange-traded fund that trades in New York, really in server farms in New Jersey, on all of the U.S. equities exchanges, and that's in the green. And they both track the S&P 500 index. There's a close arbitrage relationship between these two instruments. And you see that over the course of a trading day, they move in perfect lockstep, as they should, because they track the same underlying index, and there's a perfect arbitrage, or nearly perfect arbitrage relationship between the two of them. This is a day of data. Here's an hour of data. Here's a minute of data. And then this is a blink of an eye. This is 250 milliseconds of data. And what you see when you zoom into high frequency is that asset prices that look like they're behaving the way that efficient markets theory tells you they should actually behave in a much noisier way. Where, for example, here, the price in Chicago jumped, and the price in New York, early in New Jersey, reacted, but many milliseconds later. And as you think about it in continuous time, it's logically impossible, at least in the current market structure, that prices in Chicago and New York could move at exactly the same time. If you measure time finely enough, there's just noise and the time it takes computers to do stuff. And I'll give you theoretical models that help us think about that limit as we get to faster and faster trading speed. But there's an arbitrage opportunity here, right? At this moment, if you notice that the price in Chicago is high and the price in New York is low, the arbitrage to be had is to buy cheap in New York and sell dear in Chicago. And later there's the opposite arbitrage opportunity. So if you zoom into high frequency, the correlation between asset prices breaks down, and with that, there's massive arbitrage opportunity. So the first thing we did was we just measured how long it took for the arbitrages to close. And you see the time it takes for the arbitrages to close comes way down over time. Our data went all the way back to 2005. This is actually, I think, the first time academic researchers had used what's called direct feed data from financial exchanges. It's a faster, better time-stamped kind of data than the typical trade and quotes data that is more widely available and easier to use. We then measured how large the arbitrages are per share traded. So what's the size, the dollar value of each arbitrage? And that was actually remarkably constant over time, and I'll give you a theory for why. And then we measured the frequency of arbitrages, and the frequency varied over time, but it seemed to vary with just the volatility of the market, which makes sense. The more the market's jumping around, the more arbitrage opportunities there will be. We then measured the correlation between these asset prices. So in an efficient market, the correlation between these two assets would be 1. They both track the S&P 500 index. And you can see that at 100 milliseconds, the correlation is getting larger and larger in each year of our data. It's not 1, but it's getting larger and larger. And you can think of this as information is getting from Chicago prices into New York prices, and vice versa, faster and faster and faster each year. But at high enough frequency, the correlation is basically 0. And again, if you think about the physics, there's nothing in the market architecture that would allow prices to move at exactly the same time if time's continuous. And this is just one trade, but there's zillions like it. Zillions is not a technical term. But here is treasury instruments, other equity indices, foreign exchange, commodities. You could do this for crypto. I did it for coffee. I drink a lot of coffee. Here's just a long list. One of my collaborators used to work at Jump Trading, and just 1 hour we just wrote down just kind of bang out a list of 100 other pairs like it. There's lots of correlation in financial markets. In equity markets, you can actually do an even simpler trade than the one I showed you, which is the same stock. So a fungible security trades on lots of exchanges. That happens in crypto, right? You can trade Bitcoin or trade Ethereum on lots of different venues. So that's an even easier arbitrage trade. There's races to respond to public news. So anytime the Fed makes an announcement, for instance, that shows up in the data as a race to get data, race to respond to public news. There's race to the top of the book. There's a lot of races in modern finance. So let me go into the theory that will argue that we should think of these races as a problem that harm liquidity and that is caused by the underlying market structure. And the model's a descendant of the famous Gloston-Milgram model. So Larry Gloston, your colleague here at Columbia, is a remarkable scholar, and he's been a great friend and mentor over the years. And what my model does is actually strips out some of the complexity of Gloston and Milgram and adds one new feature that illuminates the problem with continuous trading. So in my model, there's a security, I'll call it X, that trades on a continuous limit order book market. There's a publicly observable signal, I'll call it Y, that jumps around as a Poisson process. If you like, for crypto applications, you can think of the security X as Ethereum in a Uniswap pool, and the public signal Y as prices on Binance. I'll make the purposely strong assumption that X is just worth Y. So whatever this public signal Y is jumping around, that's the value of X. So I'm going to strip away asymmetric information about the value of the asset. I'm also going to strip away any liquidation costs or inventory costs. And the goal of the model is to create kind of a best case scenario for price discovery and liquidity provision in a limit order book market. I'm stripping away all of the usual sources of costly liquidity provision in finance, like inventory costs or asymmetric information or risk aversion and so forth. The players are investors and trading firms. Investors arrive stochastically wanting to buy or sell. Trading firms are always present in the market. Their goal is just to buy cheap, sell expensive. So the way the model is set up is trying to be provocative. It's a model in which you might conjecture that Bertrand competition among trading firms would lead to zero price liquidity. Right? In the Bertrand competition model, if there's no cost, prices get competed down to zero. But that's not what happens in the continuous limit order book market design because of what we call sniping, or rents from symmetric public information. We also call it latency arbitrage. Too many terms for this phenomenon. Here's an illustration of the sniping idea. Let's say the market, here's the signal Y, here's the bids and asks around that signal. Let's say there's a jump in the value of the signal Y. That's going to lead any trading firm providing liquidity in the market to want to adjust their quotes. What does that mean in a continuous limit order book market? It means sending a message to the exchange to cancel these quotes and replace with different quotes. So sending two messages in effect. At the same time, other trading firms are going to send a message to the exchange saying, I want to buy at this old price. I want to buy at the stale quote. And in a continuous market that processes requests to trade serially, so one at a time in order of receipt, it's a race whose message gets processed first. So even if all of the market participants have exactly the same speed and understand the information exactly identically, so all 100 of us in the room have symmetric public information, symmetric trading technology, I'm still going to get sniped with high probability, probability n-1 over n. I'm going to get picked off by somebody in this room. So symmetric public information, I can't emphasize this enough, creates arbitrage rents in a continuous limit order book. The ARBs, like I showed you, like the ES SPY ARB, are just built into the market design. It's not supposed to happen in an efficient market. Coming back to the Nobel citation, it said asset prices are predictable in the long run, but, quote, next to impossible to predict in the short run. And that's economically wrong. They're actually extremely easy to predict in the extremely short run. If you want to make a 1 millisecond price prediction of SPY, you can look at where ES just went. And that creates rent. So I'm going to think about how the these rents translate into the equilibrium cost of liquidity and the equilibrium effect, the equilibrium investments on speed. So the main equilibrium condition, I'm not going to go through the full guts of the model just in the interest of time, is you have on the left-hand side the revenue a market maker collects from providing liquidity to investors. So when do I make money? I make money if an investor shows up and buys from me at my ask rather, or sells to me at my bid. And I capture the bid-ask spread. So anytime an investor shows up and trades with me, that's the reason I'm making a market, I collect half the bid-ask spread. So that's this object here. I collect S over 2 at some rate that investors show up, a Poisson arrival rate. What's the cost of making a market? Well, if there's a jump in the signal, I'm going to get picked off with some high probability. I'm going to get picked off by the difference between the jump amount and half the spread. I kind of get half the spread I make back, but I lose so I lose J minus half of my spread with that probability. And this formula, you'll notice, I lose the arbitrage with probability 1. Really, that's n minus 1 over n of the time I get sniped, and that last 1 over n is my opportunity cost of not being a sniper myself. So that's the way to think about the equilibrium. So the right-hand side is the rents to trading firms from latency arbitrage. And then if you add endogenous investments in speed into the model, you get an additional condition, which says that trading firms are going to invest in speed up to the level of these arbitrage rents. And it's like a traditional rent-seeking tournament. If you put $100 in the center of the room and say, who wants to buy a ticket to get a piece of that $100 prize, in economic equilibrium, we're going to spend about $100 fighting for that prize in the middle of the room. So the expenditure by trading firms on speed technology translates very directly to the cost in terms of an extra price of liquidity for investors. You get an equivalence in the model between the arms race prize, expenditures on speed, and the cost to investors. Profits have to come from somewhere. They come from investors. The never-ending race for speed is kind of fun to look at. So the microwave, this is the first microwave link between Chicago and New York that replaced the spread networks cable. It actually has a node in downtown Chicago next time you're there. And then this is, we compiled data from the Federal Communications Commission on just microwave application licenses on the path from Chicago to New York. And you can kind of see it filling in each year of our data. And then down here is DC. The reason DC is part of the latency arbitrage triangle is a lot of public information gets released in DC. So I think the Fed or the jobs number, that creates arbitrages. So let me talk about frequent batch auctions as the solution to this issue. At a high level, it's exactly the same market design, the limit order book, but make 2 changes. One is put time into a discrete unit. So think 1 millisecond or 12 seconds if you want to think about DeFi applications. And then process orders in a batch using a uniform price auction. You really need both of these ingredients together to solve the problem. A little bit more formally, take the trading day, divide it up into intervals of length tau. During an interval, you submit bids and asks. They have the same syntax as in a traditional limit order book, just price, direction, quantity, et cetera. You can cancel your order whenever you want. Orders remain outstanding until executed or canceled, again, just like standard limit orders. At the end of each interval, you can think of the exchange as aggregating all the outstanding orders and computing supply and demand curves and whether they cross, and executing trade at a uniform price. 2 subtleties that I think are not widely appreciated. Let me just spend a moment on them. One is the priority rule, and the other is the information policy. So the priority rule is price then time, but treating time as discrete. So what does that mean? If I have orders in the market that have been outstanding for a while, and Siamak has an order that arrives to the market in this period, I have priority over him if someone wants to execute against us. So there's still a notion of time priority. But if we enter the market at the same discrete time interval, we have the same time priority. So in a way, it solves the arms race part of the race for time priority. And then information policy, it's the same information policy as in the continuous limit order book, just disseminated in discrete time. So after each time interval, you report all trades and report the state of the order book. It just, economically, activity happens in discrete time, and then information is disseminated in discrete time. So by analogy to crypto markets, imagine if in crypto markets you often see the order before it gets economically executed, which leads to all sorts of front-running shenanigans. In a frequent batch auction properly designed, you'd see orders after they get economically processed. And the economic processing happens once per discrete time interval. So it's the discrete time analog of reporting the state of the limit order book. Another way to think about batch auctions is through 3 cases. I'll go through this quickly. Case 1 is most batch intervals, nothing happens, especially if the interval's fast, like a millisecond. You can just see supply and see demand. Supply and demand don't cross. Case 2 is a very small amount of trade happens. So there's supply and demand. Someone shows up and wants to buy at the ask or sell at the bid. You can think of that as supply and demand crossing. The third case is if there's a burst of activity in a particular interval, responding to public news, for example. And this is where frequent batch auctions and a limit order book are very different. The frequent batch auctions solves the sniping race problem for kind of 2 related reasons. So first, discrete time reduces the relevance of being a little bit faster than the competition. Right? If I'm a millisecond faster than you, but we have batch auctions once per second, it's a 1 in 1,000 chance that my speed advantage is economically relevant. Or if we do batch auctions once per millisecond and I'm a microsecond faster than you get the idea. So that's the first reason. And then the second, and I think more important and subtle reason, is the auction itself. It changes the nature of competition, where we have to compete on price, not on speed. So even if information arrives in the critical window where a speed advantage matters, I'm still competing with other fast traders in an auction rather than serial competition on speed. So let me get into some quantification of these phenomena. Okay. This is a paper that's published in 2022, and this is joint with researchers who, great, so I'll go to like 10:05 or so, or 10:10? Okay, great, I'll go kind of fast through the rest. This is a paper with researchers at the UK Financial Conduct Authority, we use a new kind of data to measure latency arbitrage in a way that hadn't previously been possible, called message data. Limit order book data are great. They provide the complete play-by-play of the limit order book. But what they're missing is in a sniping race, if I win the race and Siamak loses the race, his attempt to trade that failed actually never makes it into traditional data sources. And our simple insight is that these failure messages are a direct empirical signature of speed-sensitive trading. A race has winners and losers. Message data, the full back and forth traffic between market participants and the exchange, lets you see the winners and losers. You can kind of count up the races. So we got message data from the London Stock Exchange using some regulatory muscle, and kudos to the Financial Conduct Authority. So data that's accurate to the microsecond. And this data allows us to directly measure, after years of working with the data, a lot of the quantities I really wanted to get an understanding of. How often are there races? How long do they take? What's the level of participation? What are the economic stakes, and so forth. Here's a quick schematic of how a traditional financial exchange works. Where on the way in, a trader would send a message to what you can think of as the limit order book. But it passes through lots of stuff on the way, gateways and sequencers, and then the message comes back to the trader in question, as well as going into some kind of public data feed. And our data is captured right at the outer wall of the exchange. So if traders T1, T2 are racing, we'll see who won the race, in effect. So there's an empirical signature of a Budish-Crampton-Shim trading race as distinct from a Gloston-Milgram asymmetrically informed trader, which is that there are multiple market participants acting on the same symbol, price, and side, either taking and canceling all at the same time or all taking at the same time, some of whom succeed, some of whom fail, and fourth, all at the quote same time. The first 3 items are pretty straightforward to implement. Item 4 is a little harder because in theory there's such a thing as, quote, the same time, but in data nothing happens at exactly the same time. The main approach we use in this study is to say two trades are entered at the same time if they're so close together in time that the second couldn't possibly have been responding to the first. Practically, that's 200 millionths of a second in our data set. Pretty damn fast. So let me give you the main results of the paper. So first of all, races are very frequent, about 1 per minute per symbol for large cap stocks in the UK. They're fast. The modal race takes the difference between the first winner and the first loser of the race is between 5 to 10 millionths of a second. A huge volume of trading activity is in races. It's 22% of all trading volume. Race participation is quite concentrated. The top 6 firms in the data win and lose over 80% of races, which you expect. These are the firms, I don't know the identities, but these are the firms that are good at fast trading. Races are small per race. They average about a half a tick and just a couple of bucks. But because of the astonishingly large volume, it adds up to real economic consequences. By using a standard spread decomposition, and you can look at the paper for details of kind of the standard empirical market microstructure approach that researchers in this area have been using for 30 years, but augmented to take into account speed trading, we find that speed trading is about a third of the effective spread of the market's cost of liquidity. And then if you do a kind of theoretical counterfactual and say if you stripped out latency arbitrage from the cost of trading, you'd improve investors' cost of liquidity by 17%. And then we can also do some extrapolation. If you take the data from our study and you extrapolate to global equity markets, and this is 2016 data, so it's only grown since, it's about $5 billion per year in stock markets alone, let alone futures, currencies, options, bonds, so forth. I'm going to skip some of the details of this paper in the interest of time and just cover. I'm going to cover. Oh, good. Okay, so I think I'm going to do that anyway because I want to make sure I draw some of the connections to crypto and DeFi. Let me skip some of these facts and just talk to you about the next paper. And let me actually let me cover this slide for just a moment, which is the way to think about the magnitudes of the sniping problem is through the lens of what Mansur Olson called a concentrated dispersed phenomena. Let me kind of go through that idea. So the cost per transaction is pretty small. It's about a half basis point tax on financial volume. If you squint and look at some of the more, the less conservative scenarios we analyze in the paper, maybe you can get to 1 basis point or 2 basis points, but it's not alarming. But the overall sums are actually huge. Right? The overall sums are about up to a third of the cost of liquidity in finance, and $5 billion per year, again in 2016, in stock markets alone, let alone all the other asset classes that trade on limit order books. This creates what's called a concentrated dispersed problem, where it's small enough that ordinary investors really shouldn't worry about this. I think Michael Lewis overstepped when he went on 60 Minutes and said the market is rigged in a way that made it sound like ordinary investors should do something different in the retirement savings. I mean, you should be alarmed about it because it's in the way that you should be alarmed about lots of things that are a concentrated dispersed issue, but it shouldn't affect the way ordinary investors actually invest. But at the same time, there's billions of dollars per year for a very small number of parties in the speed race who then lobby quite fiercely to preserve the status quo, to preserve their economic rents, and that shows up in politics a lot more generally. This is a pretty clean example. Let me talk about the third paper in the stream, and then I'll get to some connections to DeFi and crypto, which is the Will the Market Fix the Market paper. This is with Robin Lee and John Shim. It just came out last month. So market design researchers usually do the kind of thing I did in the first paper, which is, oh, what's a problem in the world? What's a good market design solution to that problem? What we want to do in this paper is think about a complementary question, which is, suppose there is a good market design that academics have already innovated. Will it actually get adopted? What are the private sector incentives to adopt socially valuable market designs? Do private innovation incentives align with what's socially efficient? So the cute way to put this is, will the market fix the market? Well, market forces fix the market design problem that I've identified in the earlier in the earlier work. And some of the context for why I got interested in this project is that, as Syamak mentioned, the frequent batch auctions idea got a lot of attention from industry, from regulators. It sort of exploded pretty quickly. There has been a fair amount of innovation towards frequent batch auctions. There was the Flash Boys exchange IEX, which is kind of directionally a good idea for solving latency arbitrage. I have nuanced views on it. You can read a detailed comment letter that's on my website. In the US equity markets, there have been periodic auctions proposed by CBOE. There's the intelligent cross off-exchange platform, so an alternative trading system. There's one Kronos and PureStream or other ATSs that have a batch auction-ish component. In US equity markets, more generally, the SEC recently proposed a kind of batch auction for retail investors. So instead of a Robinhood order going to Citadel Securities, a Robinhood order would go to a batch auction. And I estimated, there's a comment letter I wrote on this too, it would probably save retail investors about 1 to 1.5 basis points, just based on the SEC's data. There's, in US futures markets, the Chicago Mercantile Exchange has filed for a bunch of patents related to batch auctions, which is, one of them actually doesn't even use the word auction, and it's kind of funny. European equity markets, lawyers can kind of work their way around anything, but European equity markets, periodic auctions are about 5% of volume. Crypto and DeFi is lots of interest as part of why I'm here. CowSwap, which I'm a little bit involved with. Vitalik's talked a lot about batch auctions, a lot of other interests. But at the same time, none of the innovations are quite what I and my collaborators advocated, or quite what we think would be best for the market as a whole. We designed frequent batch auctions, and this is especially true in the information policy and priority rules that I flagged earlier, to compete against or in replacement of the continuous limit order book. Whereas the batch auction markets we've seen are more like alongside the continuous limit order book. So in a way, the continuous limit order book has remained the center of price discovery, and the batch auctions are sort of like midpoint matching venues that are off exchange. So I use the phrase auction in name only in one of my comment letters. And it's also fair to say that the large incumbent exchanges have been somewhat hostile to the idea. So this paper is trying to understand the economics of the adoption incentive. Our explanation for this pattern in this paper is that exchanges earn part of the revenue prize from they earn economic rents from speed technology. If you're NASDAQ, you uniquely can sell fast connections to the NASDAQ exchange, and you can make economic profit. We sort of go through the economics of this, but you can make economic profits from that unique ability to sell fast access to your exchange. If you're the New York Stock Exchange, you uniquely can sell fast access to the New York Stock Exchange. It's called co-location or proprietary data feeds. At the same time, trading fees are a lousy business. I'll show the data on this. I'll show you in a slide, but it's the fees for trading stocks are as close to Bertrand competition as I've ever seen. They're extremely, and it's a lousy business. And the reason is that as a trader, I can look to New York Stock Exchange. I can also look to NASDAQ. I can frictionlessly surveil the whole market, and that generates really fierce competition on trading. And an exchange that innovated would briefly capture market share, would be able to charge a higher trading fee to get paid for solving the latency arbitrage problem, but they would lose their speed technology rents. And they would also move the industry to a new, less profitable equilibrium. So you can kind of sustain the status quo as an equilibrium of our game. And a subtlety in the background, which I won't get into in the interest of time, is the way in which financial exchange competition is subtly different from other forms of platform competition that economists have studied a lot. And the main difference is just how frictionless search is across exchanges. This is partly because of the technology and a lot because of a good regulatory environment, actually. Reg NMS and unlisted trading privileges in particular. Let me skip the details of this paper just in the interest of time, because I want to make sure I highlight some of the connections to crypto and DeFi. Encourage you to take a look at the paper. So let me draw some connections to DeFi and crypto markets, so kind of make sure I come full circle from 15 years of work to what a lot of you in this room are interested in. So first of all, and Siamak and his co-authors have worked on a concept of loss versus rebalancing, which is very closely connected to sniping and latency arbitrage. And a way to see the connection is, let's assume that Y moves around as a Brownian motion instead of as a Poisson jump process. And let's assume that X trades on an AMM, not a limit order book. So if Y moved around as a Brownian motion in my model, and X trades on a limit order book, what would the liquidity provider do? The liquidity provider would just gradually move around with the Brownian motion. There would never be any sniping. In my model, sniping always comes from jumps. Right? It's a jump that generates the race. Continuous movements in the signal generate continuous adjustments in quotes. But if the alternative market structure is an AMM, not a limit order book, then a Brownian motion generates sniping runs. And the literature prior to this paper had been confused about just the economics of AMMs and how to think about the benefits and costs of providing liquidity in an AMM. And Siamak and my colleague Anthony Zhang and my co-author Tim Roughgarden and Miliana wrote this beautiful paper that just does the mathematical decomposition of these effects very elegantly. So you can really see the effect of all of the noise in the way to compute profits and losses in these markets, and then isolate the sniping runs. So this is really cool. Then there's the idea of MEV, or minor or maximal extractable value. And I think that this is like latency arbitrage, but on steroids. Because in crypto markets, first of all, the batching is very natural, right? But Ethereum batches come once per 12 seconds. But then as a block builder, you can reorder the transactions in the batch. It's like you can control time and sequencing, which is kind of nuts. So there's lots of ways you can make money if you can reorder transactions. So the first request I have for this room or for this literature is just more quantification. So the same way that in that 2022 paper we quantify high-frequency trading, latency arbitrage races, and we were only able to do that because we used regulatory muscle in the UK. No one's done a study like that in the US. Terry Hendershot and a collaborator just did a study like that in Canada with some help from the Toronto Exchange Company, Toronto Stock Exchange. But I'd love to see more quantification in crypto and DeFi markets. Canidio and Fritsch, Andrea Canidio's at CowSwap, they have a paper that they do a version of the lever calculation, and they think it's about 5 to 10 percentage points of liquidity provider returns in an AMM, which extrapolates to like up to $1 billion per year in non-stablecoin to stablecoin AMM pools. That's a big tax on liquidity provision. I'd love to just see more data coming out of that. There's also an auction design question. One of the differences between crypto markets and traditional financial markets is in traditional financial markets, the US dollar is the natural numeraire. Right? If you want to sell Apple and buy Microsoft, you trade Apple for US dollars and you trade US dollars back for Microsoft. In crypto markets, there isn't as quite a natural numeraire, and CowSwap, which I've been involved with, has the kind of nicest batch auction design given that issue. And they actually came up with a version of an AMM that's like a uniform price batch auction, but directly in an automated market maker. So that's pretty cool. Kind of in the event that there's the jump, instead of picking off the stale quote on Uniswap, kind of automatically does the batch auction, and so eliminates the arbitrage rent and gets the liquidity provider a price that reflects the new public information. I think this is now live. I talked to Andrea yesterday, and he said it's not just a paper. This thing actually you can use it. I think another topic that I request research on is about information policy. So one of the beauties of crypto research is there's such great data on who knows what when, especially if you're willing as a researcher to just look at the mempool and just see in clock time, which you can trust as a researcher, what the sequence of events is. In traditional financial markets, there are a lot of rules about information dissemination that try to prevent For example, an exchange executing a trade at a price that the exchange knows to be stale. There's no such protections like that in crypto markets. I bet there's tons of within symbol arbitrage. This is what got Alameda research off the ground. So make crypto a good forum to study information policy and finance. Protocol design, I think, is a good topic. Hopefully we'll hear about that over the course of this conference. CowSwap and others are trying to solve MEV at the application layer. It'd be really interesting to try to solve the MEV problem at the protocol layer. So solve the problem at a level that's more abstract than financial exchanges. How can you avoid the restructuring of time? And then there's the will the market fix the market question. What are the economic forces for and against solving the MEV problem? I think of MEV as kind of ridiculous. Again, like, it's a non-starter for real finance, right? You couldn't run any kind of traditional financial applications through a system that allows some participants to reorder time the way they see fit. So whenever I read discussions of like, oh, MEV is just a way of funding funding valid, you can't have that thought and think that Ethereum is going to be serious for real finance. You can't have both of those thoughts simultaneously. I think it's just ridiculous. So are there the same Mansur-Olson concentrated dispersed forces in DeFi that there are in traditional finance? And if so, I think that's kind of ironic. Let me end there. Happy to take some questions, rants, comments. Thank you.
First, thank you for the wonderful presentation. I have a question about the batching. Wouldn't privacy, making the auctions private, eliminate the problem of sniping for the limit for the time limit of the batch?
Yeah, that's a great point. If
you have fully homomorphic encryption,
if you have privacy and the batching of the auctions, you kind of need both. What you need is that if there's a chain, let's say here's where the market is, bids and offers. Think of that as a metaphor for demand and supply. And let's say there's a public signal that the market should actually be quite higher. So a change in the price of Ethereum on Binance as an application. What you need is for the new price, for any trading in this market post the public information innovation to reflect the new public information. And for that, you either need everybody in the market to be paying attention to innovations in Y and adjusting accordingly and give some kind of priority to, or you need an auction. So I think of an auction as still an essential part of solving the problem, even with privacy. Privacy would help eliminate some of the crazy MEV stuff. But a privacy plus an auction, I think, is a more effective, for this problem at least, it's a more complete solution. I think it's a really good. I think I'd be very interested to see more research on how they complement or relate.
So I'm very interested in this topic, and I'm going to take the opportunity to ask a question myself. So I'm reflecting on like the same sniping phenomena in AMMs and Lever. One thing that we found theoretically and that others have sort of verified empirically is that if you reduce the block time, in other words, you reduce the auction time in your language, Lever shrinks, the information rents disappear. Yes. Whereas in your model, the longer the block time, the less information rent. And I think part of it, the answer to the difference in that you already alluded to, which is jumps versus diffusions, yes, right? Yes. In general, if information is flowing diffusively and you have a shorter auction time, then there's less information change, and that translates to less profits, because the profits are sort of convex in the information change. But I would think that effect also exists in TradFi markets, right? So is there a sort of, probably price evolution is a combination of jumps, yeah, and diffusive effects. So I'm wondering if you could sort of comment on that.
That's a great point. So first of all, just the math of that, just so we're all, I think Siamak and I understand it in real time, but just the sniping rent is something that has to do with a change in the price since the last auction or since the last trade or since I put in my quote, and I'm protected by half of my spread. So in AMMs, I'm protected by fees. So the analog in Siamak's work would be instead of the half spread, you'd put what is the AMM fee revenue. So the longer is the batch interval, you can think of that as like higher variance on on this statistic of how much prices have moved since the last trade. So that's going to increase rent. So in AMMs, the larger you make the fee and the smaller you make the batch interval, but also the more in AMMs, you do need the liquidity provider to adjust their quote to reflect the new public information to not get picked off. So you do need some, I think auctions do help even in AMMs in the limit as you take the batch interval short. But in traditional finance, the way I think about the Siamik's question is the longer is the batch interval, the more information there is, which can lead to more participation, in a way, more rent opportunity, but also more auctioning. You know, you got more entry and competition in the auction. What I feel confident in the research is that as you go from continuous trading to very frequent discrete trading, you get this discontinuous advantage, because going from continuous trading to, say, batch auctions once per millisecond is enough to solve all of the sniping races that are, like I showed you in that empirical study. In 2016 even, there were 10 millions of a second. The then further costs and benefits as you lengthen the batch interval are harder to study. But I think you already alluded to some of the costs and benefits. I think it's another great topic for further research.
All right, let's thank the speaker.
Thank you.